It's your boy looking at a email from Goldman Sachs to me. Um, let's check out this video, what they're talking about. In this video, the head of portfolio strategy is talking about the S&P and all this other stuff.
Hi, I'm Mariam Kamshad from the Investment Strategy Group at Goldman Sachs. Welcome to our quarterly investment update. The S&P 500 entered bear market territory in June when it fell more than 20% from its January high after a quarter marked by elevated volatility and a significant downdraft. At this level, market prices already reflect a high likelihood of a near-term recession. Since World War II, the median decline during recessions has been just 24%. So, is a recession imminent? Despite the invasion of Ukraine, spikes in food and energy prices, and inflation in general leading the Fed to aggressively raise rates, our base case remains that the U.S. will avoid a recession in the next 12 months. We now forecast a 20 to 25% probability of a U.S. recession in the next year. We consider history a useful guide. So let's take a look at 3 traditional catalysts for recessions and how we think they may apply or not to the current environment. First, external or exogenous factors. Currently, the entire world is navigating a sudden rise in energy prices, a development we call exogenous due to its origins outside individual markets or economies. As we mentioned last quarter, we don't think this is comparable to the recession-sparking oil crisis of the 1970s, both because today's price increases are exponentially smaller and because the U.S. economy today is far less dependent on oil. Second, excessive economic and financial market imbalances. The recession in the early 2000s was preceded by the dot-com equity bubble, as well as by excessive corporate leverage. The 2008 financial crisis was preceded by soaring house prices and excessive leverage in the household and financial sectors. In contrast to these earlier periods, today's U.S. economy is relatively well balanced. Finally, aggressive Fed tightening. The Fed's traditional role of taking away the punch bowl is something we're watching carefully. While we think headline inflation, which tracked at 8.6% in May, could move even higher this summer due to gas prices, we actually expect inflation to be lower by the end of the year. Despite this, any unexpectedly high inflation reports would be a source of market volatility. In June, the Fed delivered its largest interest rate hike since 1994, raising the benchmark rate by 0.75%. This was prompted by higher than expected inflation in May and an increase in inflation expectations. We expect further increases leading to a Fed funds rate in the range of 3 to 3.5% by the end of the year. However, it's important to note that tightening cycles, like the one that began in March, do not inevitably lead to a recession. Post-World War II, there have been 15 tightening cycles, and the Fed was able to avoid recession and achieve a soft landing 40% of the time. When there was a recession, it didn't begin on average until 30 months after the first hike. History shows there is a response lag before rate hikes actually impact the economy. Given elevated uncertainty, we've revised both our U.S. growth and equity forecasts downward. For 2022 overall, we now expect U.S. GDP growth of approximately 2.5%. Our revised base case equity forecast for the S&P 500 is now 4,400 to 4,500. These revisions reflect slower growth, higher interest rates, and a later peak in inflation. We recommend clients stay invested. The skew of returns from current levels is still favorable, given the large recession risk premium that's already reflected in equities. With that, thank you so much for your time today, and we look forward to speaking with you again next quarter. If you have any questions about the impact of market volatility on your personal situation, please reach out to your advisor.